Record quarterly net revenues of $3.93 billion. That is a 16% jump year over year. We've got record adjusted earnings per diluted share sitting at $3.14 and net income available to common shareholders hitting $595 million.
Yeah, top and bottom lines, just setting absolute historical watermarks across the board for Raymond James Financial's fiscal third quarter 2026.
Right. It is a massive record-breaking quarter. But, if you actually dig into the balance sheet, there is this 34% explosion in wealthy clients borrowing cash against their stock portfolios instead of actually selling their assets.
Which is wild.
It is. Are the ultra-rich betting on a never-ending bull market, or are they just terrified of the tax man? Today, we are tearing into the Raymond James Q3 2026 earnings release. And if you track wealth management or retail brokerage stocks, this is your deep dive.
Exactly. And our mission today is really just to cut out all that corporate filler, right? We want to unpack the segment performances, analyze the margin mechanics.
There's a lot there.
Oh, a ton. We'll break down management's capital allocation and, honestly, most importantly, highlight the notable risks that are buried in the footnotes. And we are going to assume you already know the basic finance terms, so we won't over-explain.
Perfect. Let's get right into the engine that actually produced the vast majority of that massive $3.93 billion top-line number, which is the private client group and the asset management segments.
Yeah, so when you look at a diversified financial services firm, it is incredibly easy to just get lost in the consolidated numbers.
Right.
But the private client group, or PCG, is the absolute bedrock of this entire operation. I mean, for this specific quarter, PCG generated a record $2.84 billion in net revenues.
Wow.
Yeah, that's a 14% jump year over year. And then asset management rode right alongside them, hitting a record $362 million in net revenues, which is up 24%.
24%, man. I always look at the fee-based accounts metric as kind of the holy grail of the modern wealth management model.
Yeah, 100%.
Because quarter-end PCG assets in fee-based accounts, they hit a record $1.15 trillion. Trillion with a T.
Yeah.
I always compare this to like a highly sticky subscription revenue model. Once a client's assets are integrated into that ecosystem, whether they're paying, a 1% or maybe a 1.5% annual advisory fee, the revenue practically just generates itself.
Right, it's recurring.
It's recurring, it's predictable, and it just scales beautifully in a rising market.
And it fundamentally changes the volatility of their earnings. I mean, unlike traditional transaction-based brokerage accounts where the firm only gets paid when a client actively makes a trade.
Like the old school stockbroker model.
Exactly, the old model. But fee-based accounts charge a percentage of the total assets regardless of activity. So if the broader market appreciates, the value of those accounts goes up, and the fees Raymond James collects increase automatically.
They basically don't have to lift a finger to see revenue growth in a bull market.
Right. Management specifically cited this market appreciation alongside net inflows into these fee-based accounts as the primary driver for that 14% revenue jump in PCG.
And those inflows are not small. Domestic PCG net new assets came in at $21.7 billion for the quarter.
That's huge.
Yeah. That represents an annualized growth rate of 5.5% right from the beginning of the quarter. Plus, they bolted on some really serious inorganic growth by closing the Clark Capital acquisition.
This was a massive deal.
Yeah, that instantly added $36 billion in financial assets under management.
And it's just such a highly strategic acquisition. Clark Capital slots perfectly into that recurring asset management engine we were just talking about. You acquire the firm, integrate their strategies directly into the Raymond James distribution network, and you just immediately start harvesting the management fees on that $36 billion.
Okay, so I see the massive top-line growth, but I was looking at the income math for PCG before we started, and I see a glaring discrepancy.
Uh-oh, what did you find?
Well, if PCG revenues jumped 14% to $2.84 billion, why did their pre-tax income only grow by a meager 3%? It was just $423 million. I mean, a 14% revenue jump should drop way more cash to the bottom line, right? Where did all that extra top-line cash actually go?
So you're seeing a very deliberate trade-off by management here. They're essentially sacrificing short-term margins for long-term asset capture.
Okay.
The revenue growth was partially offset by the impact of lower interest rates, which that squeezes the margins on client cash sweep programs.
Right, the spread gets tighter.
Exactly. But the much larger factor is their aggressive investment in growth. They explicitly noted, quote, Record recruiting results.
Meaning they're just aggressively spending cash on compensation to poach top-tier financial advisors from rival wirehouses.
Exactly that. I mean, when you recruit a heavy-hitting financial advisor, they don't pack up their desk and move their clients for free.
No, of course not.
The acquiring firm pays significant transition packages, massive upfront cash bonuses, and sometimes they offer enhanced payout grids just to entice them to jump ship.
Right.
So that there's an immediate heavy hit to the compensation expense line on the income statement in the current quarter.
So they are basically buying the advisor today, knowing that the advisor brings a multi-million or, sometimes even $1 billion book of business with them.
Right. And they bring those assets over.
Yeah, and then those new client assets get plugged straight into that sticky subscription-style fee structure we just talked about.
Exactly.
So it depresses the pre-tax income growth right now, holding it to just that 3%. But it really fuels that AUA snowball for tomorrow.
It is a massive land grab. If you believe the long-term value of a wealthy client's recurring fees heavily outweighs the upfront cost of acquiring their advisor, you make that trade every single time.
It makes sense.
It's a very aggressive capital allocation strategy that tells us they are entirely focused on playing the long game.
But, paying massive cash bonuses to recruit all these top-tier advisors requires immense liquidity. You need serious cash flow.
You definitely do.
So where is Raymond James getting the explosive profit growth to actually help fund this? And that brings us to the completely opposite side of the business, which is capital markets.
Yes, the cyclical side.
Right. If PCG is the steady, recurring engine, capital markets is the highly cyclical, transactional side that provided this quarter's most explosive percentage growth.
I did. This segment can be incredibly volatile, but the volatility worked heavily in their favor this time around. Capital markets net revenues came in at $477 million, which is up 25% year over year.
Huge.
And the real driver here was investment banking, which hit $285 million. That is a massive 40% surge from the exact same quarter last year.
A 40% jump in investment banking just feels like corporate America woke up from a 2-year coma.
It really does.
I always look at capital markets as the lumpy part of the income statement. If the private client group is a property manager collecting a steady monthly rent, capital markets is the real estate agent.
That's a great way to look at it.
Yeah, they only eat when they close a massive transaction. No deals, no commissions. Pre-tax income for the segment was $48 million. But the swing is what really catches my eye here.
The year-over-year swing.
Yeah. In the same quarter last year, this exact segment posted a $54 million pre-tax loss. So I'm guessing this means the fear of endless interest rate hikes is finally over for these companies.
The ice has completely thawed. That 40% surge in investment banking was driven by a stark rebound in advisory revenues for mergers and acquisitions, and also just higher debt and equity underwriting.
Because they were just frozen before.
Completely frozen. For a long stretch, corporate boards were terrified of interest rate volatility. The cost of capital was entirely unpredictable, so they literally just sat on their hands. M&A dried up, and IPOs vanished.
Which explains the huge loss last year.
Exactly. That's why Raymond James took that $54 million pre-tax loss last year. I mean, they still had to pay their bankers their base salaries, but no deals were closing.
So this is operating leverage in action. The fixed costs of employing those investment bankers stay relatively flat. So when the corporate environment finally stabilizes and that revenue variable spikes 25%, the profits just explode straight from a heavy loss to a really solid gain.
Corporate confidence has absolutely returned. You see companies buying competitors, they're issuing bonds to refinance older debt, and they are tapping the equity markets. And every time they execute one of those moves, Raymond James's deal makers take a cut.
Right.
But again, like you said, it's lumpy. You cannot project a 40% growth rate into infinity because it relies entirely on the macro environment staying accommodating for deal making.
Which perfectly highlights the importance of the balance sheet. Deal making, advisor recruiting, client cash sweeps. All of this relies heavily on how Raymond James manages its lending and its interest rate exposure.
It all ties back to the bank.
Exactly. Let's look at the bank segment and the margin mechanics.
Yeah, so the bank segment posted net revenues of $488 million, up a solid 7% year over year. But the real story is further down the income statement. Pre-tax income surged 67% year over year to a record $206 million.
And their loan growth is just incredibly aggressive right now. Record net bank loans hit $56.2 billion, up 13% over June of last year.
Right.
And inside that loan portfolio is where we find a massive behavioral shift. Securities-based loans, or SBLs, absolutely exploded by 34% year over year to $24.8 billion.
That number is wild.
Just to be clear on the mechanism here for you listening, an SBL allows a wealthy retail client to borrow cash from Raymond James using their own investment portfolio as collateral.
Right. So instead of actually liquidating their portfolio to get cash and triggering a tax event, they maintain their market positions and just take out a line of credit against it.
Yep.
We also saw residential mortgages grow by 13%. But, we really need to look at how they are making money on this volume. The net interest margin, the NI, which is the spread between what the bank earns on these loans and what it pays out on deposits.
Right, the core profitability metric for the bank.
Exactly. The NIM slightly compressed to 2.71%. That's down 3 basis points year over year, and actually down 10 basis points sequentially from the previous quarter.
Okay, let me zero in on this income math for a second, because the net interest margin actually went down. The spread they are making is actively tightening.
Yep.
Yet the bank pre-tax income spiked 67%. To understand that, you have to look at the non-compensation expenses. Specifically, the bank loan provision for credit losses, or in this quarter's case, the benefit for credit losses. They reported a $26 million benefit.
Which is a stark contrast to the $15 million provision expense they took in the same quarter last year just to cover potential bad loans.
Right. I always equate this to a landlord who sets aside a massive security deposit, assuming the tenant is going to just completely thrash the place.
That's a perfect analogy.
Right. But then the tenant moves out, the apartment is pristine, and the landlord suddenly realizes they get to just keep that cash. They are taking money they had walled off for bad loans and releasing it directly into their profit pool.
And just like that landlord, Raymond James is realizing their borrower's credit health is pristine. The collateral is holding up perfectly.
Because it's backed by huge stock portfolios.
Exactly. Management noted this $26 million benefit reflects very strong credit quality across the entire loan portfolio. Their borrowers are paying them back on time, so they just don't need to hold nearly as much in reserve for defaults.
Right.
They get to release those reserves straight to the bottom line. But a 67% profit jump isn't just about releasing reserves.
Right. Eventually, the reserves hit the minimum regulatory level, and that benefit just dries up. So what is the second factor that's offsetting that shrinking interest margin?
The sheer volume of loan growth. Volume cures a lot of margin ailments.
Oh, for sure.
When your net interest margin compresses by 3 basis points, you make slightly less profit on every single dollar you lend out. But if you lend out significantly more dollars, you easily outpace the margin squeeze.
Right. You make it up in bulk.
Exactly. That 34% surge in securities-based loans to $24.8 billion is massive volume. It proves they can grow profits through sheer scale even when the lending spreads tighten slightly.
Okay, so we have the wealth management juggernaut capturing assets, we've got the capital markets deal-making rebound, and an expanding bank balance sheet masking a margin squeeze with just massive volume.
It's a very strong hand.
So what is management doing with all this record cash flow, and what is CEO Paul Shoukry signaling for the rest of the year?
Well, the commentary from CEO Paul Shoukry was highly optimistic. He pointed to, quote, significant momentum heading into the fiscal fourth quarter. He specifically cited historically strong business drivers, robust financial advisor recruiting pipelines, and really strong investment banking pipelines.
They clearly have ample liquidity to support all this growth, and we see exactly how they're deploying it in the capital returns. During the quarter, Raymond James repurchased $400 million of common stock at an average price of $152 per share.
Which is a big chunk.
Yeah, and they still have $1.1 billion remaining on their board-approved repurchase authorization.
Returning that level of capital to shareholders while simultaneously funding record advisor recruiting, that just shows immense confidence from the board in their future cash flows.
They aren't scared right now.
Not at all. They are maintaining a fortress-like balance sheet while doing it. At the end of the quarter, their total capital ratio sat at 22.5%, which is well above regulatory requirements.
I also noticed the effective tax rate dropped to 20.7% for the quarter.
Yeah, the earnings release explicitly stated that drop reflects the favorable impact of non-taxable gains on their corporate-owned life insurance portfolio.
Okay, interesting.
Yeah, it is a very common, entirely legal strategy that massive financial institutions use to manage their effective tax rates and help fund future liabilities.
So you have a management team buying back $400 million in stock, spending heavily to poach rival advisors, writing a massive investment Birking ways, and legally shielding income from taxes.
They were busy.
That is a management team playing highly aggressive offense. But, we aren't here to just read the highlights and cheerlead. Every balance sheet has weaknesses. So what are the notable risks buried in this report?
There are definitely two main risks that demand attention. First, if you look at the segment breakdown, there's the other segment. This segment actually posted a pre-tax loss of $70 million for the quarter.
Which is notably worse than the $42 million pre-tax loss that same segment posted in the year-ago quarter. What is dragging that down so much?
The data shows this widening loss was driven by higher interest expenses on corporate debt. Yeah. We just talked about how Raymond James Bank benefits from lending out money at higher rates. But the parent company, Raymond James Financial, also borrows money to fund its own operations.
Oh, right. It goes both ways.
Exactly.
Yeah.
As interest rates stay elevated, the cost to service their own corporate debt increases. It eats into the massive profits generated by the operating segments. It's a $70 million drag on the bottom line because the cost of capital bites both ways.
If rates stay higher for longer, that $70 million drag isn't going anywhere.
No, it's not.
What is the second major risk?
The heady, almost inescapable reliance on broader market appreciation.
The double-edged sword of the fee model.
Exactly. We said the first segment talking about how that $1.92 trillion in client assets under administration generates beautiful, sticky, fee-based revenue. But that AUA is deeply tied to the valuation of the stock market.
Right.
If we see a broader macroeconomic pullback, say a 10% or a 15% market correction, that $1.92 trillion shrinks proportionally.
And when the AUA shrinks, that sticky fee-based revenue takes an automatic haircut, even if Raymond James doesn't lose a single client.
None of them have to leave for the revenue to drop.
Right. Their fortunes are heavily tethered to the general direction in the financial markets.
It is the unavoidable reality of the wealth management model. You live and die by the health of global markets. You can recruit all the top advisors you want, but if the S&P 500 drops 20%, your fee revenue just plummets.
Which brings us back to that massive behavioral shift we teased at the very beginning of the show, the macroeconomic puzzle that's hidden deep in the bank segment data.
The SBLs.
Yes, securities-based loans, the SBLs, grew by a massive 34% year over year, reaching nearly $25 billion.
The mechanism here is just fascinating. An SBL allows a wealthy client to access liquidity without triggering a taxable event.
Right, so instead of selling $1 million worth of stock to, buy a second home, fund a new business venture, or even pay a tax bill, they just take a loan against the stock and pay Raymond James Bank the interest.
Exactly. The client gets the cash, and Raymond James gets the interest income.
The question you have to ask is, what does it mean when wealthy retail clients are aggressively borrowing cash against their investment portfolios instead of liquidating their stocks? I mean, a 34% growth rate in a single year is a staggering trend.
It really is. It shows that liquidity is being accessed through leverage rather than liquidation.
Right. Are these high net worth clients exhibiting supreme confidence? Do they truly believe we are in a never-ending bull market, so they absolutely refuse to sell their appreciating assets?
Or is it simply a sophisticated, highly calculated strategy to avoid massive capital gains taxes in a market that has run up so far so fast?
Yeah, because the tax hit is huge.
It is. If you sell, you owe the government 20% right off the top. If you borrow, you just pay Raymond James a single-digit interest rate and let the asset keep compounding.
It's likely a mix of both, honestly, but it is a trend worth watching closely. Not just for Raymond James, but for what it signals about the entire luxury and high-end retail economy. Are the wealthy supremely confident in the market's future, or just aggressively tax-averse? That is a lingering thought to take with you as you analyze the broader market this week.
It's a great question to end on.
And that wraps our deep dive into the Raymond James Q3 2026 earnings report. We cut the fluff, tracked the margin mechanics, unpacked the aggressive recruiting strategies, and found the hidden levers driving the profits. Make sure you follow the show for daily, no-nonsense earnings coverage tailored for the investor who actually wants to understand the math behind the headlines. We'll catch you on the next one.